After the Dow hit a 12-year low last week and we're now officially 50% below the high, I think we can put to rest the idea that the stock market likes Republicans or Democrats better than the other. It's an interesting phenomenon. We have clients, really smart people, who are convinced that the problem with the stock market is the president. The curious thing is that some of them think Obama's a problem, some of them think it's Bush. I think the problem is a lot more complex than just who lives in the White House, and it may actually be mostly irrelevant to who lives in the White House. Here's an interesting thing. My kids don't even have a CD player. They listen to iPods, and I don't think they've ever even seen a record player. And as a result, they have no idea what it means when you say something sounds like a broken record. But they do know what it's like to hear the same thing over and over again. Just because you hear something repeatedly, it doesn't mean that what you hear isn't true. But I know it's irritating to hear a broken record. And I know that's how some people feel when they hear the same observations about the stock market. It's repetitive. But what I'm about to say right now is actually more true than it was 2 years ago. Over the long haul, stocks outperform other asset classes. It's especially true when you're starting from a point where prices are half of where they were less than 2 years ago. There's a risk that as the market gets closer to a rational bottom, wherever that is, the emotional risks increase and you have this temptation to do the wrong thing. You see, there's a natural tendency that humans have to give greater importance to newer information. It doesn't matter if the newer information is more important, it's just that when we get newer information, we tend to think that it's more important. Let me give you an example. Last April, in 2008, a Rasmussen poll found that 73% of Americans thought that global warming was at least somewhat serious. 9 months later, same poll done by the same people in January 2009, the number had dropped from 73% to 64%. There weren't any new scientific findings, but fewer people think that global warming is as serious of a problem. Why? Because it snowed a lot in December. People took their most recent piece of personal experience and then they extrapolated it. They extrapolated that feeling out into some long period. We do the exact same thing with stocks. We think that whatever happened most recently is likely to keep happening, even though history shows us that stocks and bonds, they have a certain return and that those returns tend to revert back to a mean. And to get back to that mean, stock returns have to go up, particularly from this point, and bond returns have to go down. I know this sounds like a broken record, but there's no way to know when that'll happen. Every week it seems that we hear something else about another fraud or a Ponzi scheme somewhere. And you would think that with all the publicity surrounding these types of things, people would be less likely to fall for scams right now. See, that's the logical response. But scams aren't logical. They don't appeal to people's ration. They appeal to people's emotion. When the stock market's off 50% in a year and a half, emotions are at a high point. And that's when people are most vulnerable. They're most vulnerable to falling for scams when their emotions are at their peak. There are actually 3 different types of scams. There's an outright scam, like a Ponzi scheme, and then there's an almost scam. That's something that's legal, but it's misleading. In my opinion, it's a lot like annuity products or equity-linked CDs. These are things that cost too much, or their fees are too high, or they're inappropriately sold. And then there are things that I call legitimate scams. These are things that are perfectly legitimate investment vehicles, but the people who sell them are the ones who are illegitimate. This is probably the area where the most activity is taking place right now. Somebody who says that he knows when the market's going to go up or that he knows when it's about to decline. He has some special tool or insight where he can provide value to you. Look, Warren Buffett doesn't know those things. There's sure not some guy in West Knoxville who does. The smartest people I know in this business lost money last year. Keep that in mind as people approach you about the next scam. People ask us all the time, when is this going to be over? And to answer the question, we have to know what the it is. Because it could be a couple of different things. Is the it the stock market? Is the it the economy? Is the it some certain aspects of the economy? All those things are related, but if you're asking the term, when does the turnaround happen? All those things turn around at different times. You know, we'd like to forget about Freddie Mac from last year, but we can't talk about the state of the economy and what has to happen for the economy to bottom, find its bottom, and then begin to strengthen again without talking about the housing market. And you can't talk about the housing market without talking about Fannie Mae and Freddie Mac. There's so many people who are already predisposed against business and free market and capitalism, and they think that all the bad things that have happened in the last 15 months proves that the market or free markets or freer markets lead to disaster. That's not what this proves at all. The first thing we have to realize is that we've forgotten that recessions happen. We had a recession in 2001, but it was barely a recession. It doesn't even count. It was minuscule. We had practically no job losses. The last real recession we had started back in 1990. That's 17 years of practically uninterrupted economic expansion. And one of the reasons that it went so long is that the Fed propped up the economy. The Federal Reserve Board propped up the economy, and it extended the expansion by pushing interest rates lower. The recession was not the failure of the markets. It was a natural occurrence of the economy. It was a natural occurrence of the economy that was made worse by the government subsidizing access to credit over the last 15 years. The government did it in a couple of ways. One was just by influencing the general level of interest rates. That mostly manifested itself by seeing an increase in general corporate borrowing. But the other thing that we saw is the way that Freddie Mac and Fannie Mae operated to subsidize the housing industry. One of the primary things that made Freddie and Fannie attractive investments from an equity standpoint for so long is that they could borrow money at rates that were close to what the federal government could borrow and then fund mortgages at lower rates than anybody else could do. This didn't eliminate the cost of funds part of the mortgage rate, but what it did do is it reduced that part of the interest rate because Freddie and Fannie didn't have the same cost of funds that any other mortgage originator had. It made the overall mortgage rate lower than it should have been in a free market because the government was subsidizing rates by implicitly guaranteeing the debt of Freddie Mac and Fannie Mae. And these lower rates, what they did was they let people buy more expensive homes and they pushed home prices higher and did things that would have otherwise never happened in a private market. Those lower mortgage rates and then ultimately easier underwriting standards, they drove the growth of the securitized asset industry. And this securitized asset industry provided billions of dollars of capital to the business community, which fueled all sorts of economic growth. Well, that's stopped. Or at least it's changed. But here's what's happening. To solve our economic problems, and these are problems that started as a result of an overheated housing market, what we, and when I say we, I mean the government, what we're trying to do is manipulate housing prices. If this were the stock market, what the federal government's doing right now would be illegal. Now think about this. If you had a margin account and your stocks had declined and you were about to have a margin call, and the government was trying to prop up stock prices to prevent margin calls, that'd be market manipulation. Theoretically, somebody could go to jail for that. But people don't sleep in brokerage accounts. Margin accounts don't have swing sets or front yards, or kids don't play in margin accounts. We think about houses differently than we do other assets. And that's okay. That's fine. We just need to realize what's happening. The problem, or at least the challenge that we have, is that what's good for the economy in the big picture sense, parts of that are very difficult. Parts of that, in some cases, the things that are good for the economy in the big picture sense are devastating for individuals. And that's hard. That's where you end up with all sorts of disagreement about how we ought to proceed. You see, for the economy to find its natural bottom and then to be able to begin to strengthen again, a lot of things have to happen. But most of those things are predicated on houses finding an equilibrium price level. House prices will eventually have to come down to a point where willing buyers and sellers will engage in transactions. The big picture question is a question that ought to be answered by economists. But then there's this people question, and that is what's the best for individuals on a person-by-person basis? And that's not a question for economists. That's a question that ought to be answered by social service agencies or ethicists or counselors. Or in our country, what happens is it ends up getting answered by politicians. And the frustrating thing is that the answers to those questions, the big picture, fix the economy question, and then the help the people question, the answer to those questions are in conflict with each other. At least they are in the short term. Here's the thing I hope you'll remember. This is not the Great Depression. At least at this point, what it does is it looks a whole lot more like 1981 than it does 1929 or 1930 or 31. It looks a lot more like the 81 recession. Last year, the U.S. economy lost 2.2% of its jobs. And that's about what we lost in a 12-month period in the 1981 to 1982 recession. In the Great Depression, we went 3 straight years where we almost lost 5% of the jobs, and then 6%, and then in the third year, more than 7% of the jobs in the country. Nobody right now is talking about job losses like that in this country. We're still more than 3 percentage points below the 1981 unemployment rate. And in 1932, more than 25% of the adult workforce was unemployed. The thing that we use to measure economic activity, the GDP, gross domestic product, it's nowhere near the levels that we saw during the Great Depression. This is not the Great Depression. I'm not a fan of bank nationalization or the threat of bank nationalization or the threat of increased bank nationalization, but you know what? I don't like daylight savings time either. The point is that the government does things all the time that different people think will be disastrous, and they're not. Try to put yourself back in 1982. Short-term interest rates were pushing 20%. We had over 3,000 bank failures. The Dow Jones Industrial Average right now at a 12-year low. In 1982, it bottomed at the same level that it traded in 1970, 12 years earlier. In 1982, to a lot of the country, it felt like the economic world was ending, but it didn't. And I don't think it will this time either.